everyone, welcome to SST College of Arts and Commerce and welcome to SST Edupedia. I am Assistant Professor Manmeet Kaur, Faculty Member of BMS Department, will be continuing with the subject of Risk Management for Semester 5. Our module is Risk Management in Insurance Sector. Now what is insurance? Insurance is a contract represented by a policy in which an individual or an entity receives financial protection. The financial protection can be for the life or for a particular asset. Insurance is of many types. So basically insurance is what? Where two parties agree for a particular monthly or quarterly or 6 months, half yearly, a particular premium amount to be paid to the insurance company, where in return they will give the protection in monetary terms. Reimbursement can also be there against the losses from the insurance company. The company pools clients' risk to make payments more affordable for the assured. So we are the assured as we take the insurance policy. We pay certain amount of premium to them. In return, we expect the protection from the uncertainty. Insurance policies are used to hedge against the risk. This is kind of a shield we are using against the problems of financial losses, both big or small, that may result from damage to insured or her property from liability or damage or injury or whatever the case may be. So in short, insurance is an agreement that is for financial protection. The types of insurance that we have are vehicle, property, health, life, travel and credit insurance. Credit insurance, where we have taken the credit, it is supported by the insurance company. Now who regulates the insurance activities? Insurance Regulatory and Development Authority of India, known as IRDAI. What they does, it is an apex body that supervises and regulates the insurance sector. It supervises whatever the activities are being held and what the process is there where in malpractices or exploitation of the client is happening. There we can take the help of IRDAI. We can approach to them and find the solution. The primary purpose of IRDAI is to safeguard the interest of policyholders so that no exploitation is done, and they ensure the growth of the sector in the country. When it comes to regulating the insurance industry, it not only looks after it, but it also gives general insurance and other kind of insurance to the client. The framework of regulatory body is, it comprises of insurance companies. To represent the company, there are agents, insurance advisory committees where some kind of uncertainty or issue arises, the experts are there to assist. Insurance tariff, for tariff also they provide the advisory services. Insurance association or council, brokers and agents are available. Losses are monitored, and if we are outsourcing or involving a third party, then also the regulatory body comes into the picture. We have to make sure that we are doing the activities according and under the rules and regulations. What are the duties and powers of IRDAI? Under section 14, IRDAI Act 1999 lays down the duties and functions with powers of IRDAI. Registering and regulating insurance companies. The registration are done under the Act to make sure that no fake companies to unnecessary disturb or to exploit the clients are there. They make sure that protection of the clients or the policy holder is assured, licensing and establishing the norms on which we have to make sure that we are following the norms and rules to execute the policy, promoting professional organizations in insurance. The insurance agents and brokers professionally work and represent the company, so we have to make sure that they are working under certain rules and frameworks, regulating and overseeing premium rates and the terms of non-life insurance covers. The premium rates are fixed according to the Act. So if there are private companies providing the insurance services, they may charge higher rates, they may charge other rates. So we have to make sure that under the Act we are providing or asking for the proper and reasonable rates. Specifying financial reporting norms, all the activities under the regulatory body which we are doing, we have to make sure that we are reporting and we are keeping proper records and everything of all the policy related things. Regulating investment of policy holders, many people do this as an investment also, so we have to make sure that unnecessary people are not putting it into it. Ensuring the maintenance of solvency. See, insurance company provides financial support at the time when we need money, but we as an insurance company we have to make sure that we have sufficient solvency, liquidity with us when certain client comes up with a problem, when a client claims the insurance. So we should be having sufficient money to satisfy their issue after analyzing, after assessing what kind of risk it has. Assuring the maintenance of solvency margin. We have to make sure that solvency margin is properly set with the profit margin also. Ensuring insurance coverage in rural areas also. We have to make sure that rural areas, backward areas, vulnerable areas are covered under our team. Now, difference between life insurance and general insurance is, life insurance the risk is certain, but in general insurance the risk is not certain. Objects is to secure future and to make investment in life insurance, but here we are currently supervising or we are focusing on the current situation to get the security towards or against the damage or the loss which we have faced. The time period for life insurance is longer, comparatively a longer period, but in general insurance the period is predetermined and it is set or it is agreed upon on the time of signing the policy papers. The amount of premium is linked to the age of the assured and the period of the policy in case of life insurance, and the premium is fixed as per the nature of risk involved and the nature of the policy, type of policy that we are taking in terms of general insurance. Insurable interest must exist at the time of the person on whom we are taking the life insurance policy. That person should be present while acquiring the, or I can say while signing, or when we are initiating the policy, that person should be there. Insurable interest must exist at the time of contract and also at the time of the loss. And then at the time of loss or damage, we will make sure that we are investigating and we are genuinely observing that the claim is authentic or not. Now the next topic we have is reinsurance. It is known as insurance for insurers or stop loss insurance. It is a practice where insurers, means the company, transfers the portion, they transfer some portion of their policy to some other company. This can be also called as, for understanding purpose, as outsourcing. insurers transfer portion of their risk portfolio to other parties by some form of agreement to reduce the likelihood, to reduce the risk of paying on large obligation. If the amount is of larger amount, if the amount is more high amount, then we will try to make sure that we are dividing the amount and the division amount is given to another company, so that the whole burden at the time of loss or at the time of claiming, if I may say, is not on one company or one person. The party that diversifies its insurance portfolio is known as ceding party. So the third party that will be involved over here will be known as ceding party. The party that accepts the portion of the potential obligation in exchange of share insurance premium. So whatever premium the insured party will pay, that will also be divided between the ceding party and the main insurer from the first point of view. So reinsures by treaty. It is insurance companies entering into reinsurance contract with another company. So two or more parties get involved over here collectively to divide the risk and to divide or enjoy, if I may say, the premium they are getting from the client. An agreement is in the place with the insurance company and the direct writer. Reinsurance companies offer different proposals to ceding companies mentioning the maximum risk. So when the ceding company comes up with this thing, they are analyzing the risk to make sure that they are not they doesn't comprises of any loss or risk in the future to their goodwill. So if parties are involving over here, those parties make sure that they are not harmful in the near future. Next we have facultative. In this kind of reinsurance, individual policies are considered and decision is taken on what policy needs to be provided to the person. So the client here is not directly given the policy. They sit collectively, they make a decision, and then collectively the policy is offered or introduced to the client. Multiple companies can cover different individual policies. Here what they do, the purpose of reinsurance is to minimize their risk and to divide it properly. This way alliances are also made stronger and they work as a team where it is beneficial to everyone. Now bancassurance is an agreement between a bank and an insurance company. Now rather than connecting or calling out to insurance company, an insurance company will contact a bank already to sell its product to bank's client base. So here the client is of bank. This partnership arrangement can be profitable for both the companies. Banks earn additional revenue by this kind of agreement. They sell the insurance policies to the potential clients. So both the parties, again over here, the bank and the insurance company will have a benefit of their own to work in their future. The insurance company benefits from increased sales, and on broader clients they can have large amount or higher amounts of clients to satisfy them according to their requirement. The bank benefits by receiving additional revenue from the sale of insurance products. The modules here, distribution of agreement, here the bank sells insurance to another insurer. Strategic alliance is there. The strategic alliance, the alliance of bank and insurance company is stronger. Joint venture, we can call a big banks and big insurance company come together and they make a distribution channel. The clients who come up with the policy, they who sign or take the policy, they are also satisfied that their money or their uncertainty which may arise or whatever the purpose they are taking insurance for is in safe hands. Financial service group, it is a group, it is a team which helps you in the time of the need. Advantages, trust can be earned, bank has customers, financial position of the company, the growth of the company can be seen very easily. diversification of companies and the clients, the scope we can cover is expanded. One-stop solution to all your financial issues at one place, where bank and the insurance company are shaking their hands. Disadvantages: it requires more initial investment. The investment in the initial stages is higher comparative to other policies, time consuming, and need more number of employees. Obviously, if we are connecting to higher level of clients where monetary terms are also higher, we have to make sure that we have those number of and those quality of employees who can satisfy the needs. Critical success factors: it can be management committee should be efficient, should be properly working. Insurance is not an additional, but it is a crucial part. It is a need. We all have the insurance policy of some or the other kind, or multiple kind of insurance policies. So it is a need, it is a crucial part of the success. So bank, for their success, for expanding their growth or expanding their scope, they make sure that they do this kind of tie-ups to ensure that they are having a fruitful future. What are the challenges which we can face here? Cooperation: we need the cooperation between the bank and the company, the communication, the coordination. If one is lacking somewhere, the other one should give the backup. Increase the workload should not be pressurized on certain employees. That's why earlier I mentioned that number of employees are increased over here. Difficult to identify the legal responsibilities. Internet banking and mobile banking plays a very important role, and it supports the system. Insurance claim: now when we make the insurance claim, it is a formal request which client makes to the insurance company for the coverage or for the compensation of the premiums that we have done. The insurance company validates the claim or denies the claim. After their investigation, they will decide whether the claim is authentic or it is, build up a thing. The insurance company validates the claim or it rejects. If it is approved, then insurance company will issue the payment to the client, and it is approved the interest to the interested party. The insurance company validates the claim, and once approved, it issues the payment. For property casualty insurance, for car or home, filing a claim can cause rate hikes in your future premiums, where, for example, there is a vehicle accident or a mishap that may have happened. So the insurance company makes sure that that kind of mishap is not happened because of the person or the insured. So all the investigation is done to make sure that insurance claim is properly executed. So what are the steps? There are 5 steps. The very first step is connect with your bank. The person, the insurance, will connect to the bank because obviously the payment needs to be made. So it connects. They are the primary person to contact when the insurance policy is on the edge of being claimed. Then second is we do the investigation whether it is authentic or not. Then your policy is properly revived or not, whether your policy is, your premiums were on time or not. All the history of your will be again checked when the claim process starts. The damage is valid or not, it is evaluated properly. Any type of insurance kind, it will be checked and investigated. And lastly, when the insurance company is satisfied, then the payment of the claim will be issued. So risk is a kind of a thing which is like a partner with all kind of activities, whether we are in management or we are in banking sectors or we are in other insurance sectors. So risk is always there. With that, management comprises of risk management, assurance, governance. We have to make sure that all these activities are properly executed by risk management. Thank you.